Hey there, everyone. Happy Monday. It's December 11th, 2023, and welcome to this episode of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The Charting and Technical Analysis Toolkit is really intended to give investors a better sense of what's happening around you, and no better time than now as we have a pretty busy week. Looking forward to the days to come. We have the November CPI number coming out on Tuesday. On Wednesday, we have the second day of the Fed meeting with the update on the Fed open market, or the Fed target rate, and also Powell's press conference, where I know many investors, including this one, will be hanging on to Powell's comments just to get a sense of what the trajectory may be in the 12 months to come. We've had a lot of really cool conversations with some of our guests in recent weeks talking about this upcoming Fed meeting, talking about expectations for the first quarter of 2024 and beyond. We have our 2024 market outlook special coming up later in the month of December. We have a lot more great conversations happening this week with some of our guests, but let's get to the markets today. By the way, today's session on Monday, what we like to do is do a quick poll, we'll do a quick market update, then we will go live to the Q&A, so get your questions in now. Recently we asked you, and we like to do this every weekend actually, what's your outlook for U.S. stocks for the next 6 months? Bullish, bearish, neutral. This week we came in at 51% bulls, 24% neutral, 25% bears, just a slight downtick in bullishness from 52%, a slight uptick in the neutral rating from 25 to 24%. So a downtick there, and a couple more bulls there from 23% up to 25%. We're very interesting to track this particular question that we're asking about once a week to see how it evolves into the beginning of 2024. For now, certainly most investors that we're surveying in our poll bullish, and it's hard to argue with that when you look at the evidence in the markets, right? Semiconductors breaking out today. A lot of the travel and tourism names that have had a pretty strong November into December continue to push to the upside as well. MGM making a nice swing high, up 5% today. Today it's a lot about the semiconductor space. We're going to look a little bit at Broadcom, at Applied Materials, the SMH, the SOXX, sort of the broader ETFs. Strength in semiconductors usually means strength for the overall market, but today, top performing sector, consumer staples, kind of a defensive sector. With that in mind, let's get to the market update. And again, we'll do a brief market update here. And as a reminder, let you know to go to the live Q&A as we go along. Get your questions in now. We'll start at the top, kind of continue on there. Looking at the S&P 500 here to kick things off, up 0.4%. And a lot of that came right at the end, actually. The afternoon was fairly strong. We had a nice push to the upside in the last 10 minutes of trading. Overall, putting the S&P to around 4622 at the end of the day. The NASDAQ composite up 0.2%. Mid caps and small caps both up about 0.5% as well, so slightly outpacing the S&P 500, but overall kind of the same. This is an interesting one to pay attention to. The S&P 100, sort of the S&P mega cap index, flat from Friday's close. So again, not a huge difference from the S&P up 0.4% and the S&P 100 up 0, but it is a difference, and keep an eye on that, because what you're finding, or at least what I'm finding, is some of those names that have had really incredible moves to the upside, like things like AT&T and Verizon, right? Sort of the not juicy, not offensive part of the market, but certainly some areas of the market showing consistent strength, pulling back quite a bit today. So the mega cap index actually flat. Charts like Nvidia not doing particularly well today, while others doing just fine. We'll try to tease out some of those nuances here through the course of our market update. The VIX pushing up just a little bit, still in that 12 handle, so still in the 12 range. But up about a quarter of a point from Friday's close. So still relatively low compared to the range over the last 12 months. Certainly relatively low compared to the last number of years, to be honest with you. When we talked on the end of last week, I think it was on Thursday's show, about what we would need to see to maybe change our perspective, an increase in volatility would certainly be a part of that story. Let's go to the bond markets. No significant changes from Friday's close, to be honest with you. The TLT, which is a good proxy for Treasury bond prices, down slightly from Friday's close. The yield curve, to be honest with you, not much change. This is not surprising, to be honest with you, when you have a big economic number coming out on Tuesday. The Fed, of course, coming out on Wednesday. My back of the envelope thinking of what the week most likely looks like. Monday is a treading water, just wait and see sort of day. Tuesday, probably a lighter day unless there's a big shock from the CPI data, right? So if there's a big jump in inflation, for example, and the implication is that that might adjust what we hear from Powell on Wednesday. I could see that being a big mover. If it kind of comes in line, I would expect kind of a lighter volume, wait and see mode as well. It's going to be all about Wednesday this week, and then Thursday and Friday will be reaction to what we heard on Wednesday, with some earnings and random things peppered in, but no big change in bonds, no real change in the dollar. Makes sense to me given the weight of the announcements we have coming up over the next couple days. Commodities down slightly, so the DBC, which is a broad commodity ETF, down about 1/3%. Gold and silver both down about 1%. That's something to watch as well because gold, a couple of weeks ago, we're talking about gold with this potentially huge monster breakout. Gold stocks breaking out of a key resistance level. Spot gold testing all-time highs around $2,100 an ounce. All of that reversing here in the last week or two. So the GLD down another 1% today. Silver prices, copper prices down as well. Crude oil actually slightly higher, although energy not a real big winner compared to where we ended the week last week. Cryptocurrencies, we've got to spend a few moments here, and we're going to look at the chart of Bitcoin here in a minute. A lot of red on here, and I've looked around quite a bit. I'm not seeing any particular catalyst for this. What it seems to me is this is sort of a more of a market structure type of thing or a sentiment change. So it could be closing positions, big option trades winding down, just profit taking given the big rally that we've seen in Bitcoin. Talking to some of my friends in this space, when this thing rolls over, what happens is it's been such a good uptrend. If you have a trailing stop that's been following things up, today probably triggered it, or maybe over the weekend. And now what happens is stops get triggered. That causes more selling. That causes more stops to get triggered. That's when you can have what's called a cascade of selling, right? Or a selling cascade as selling begets further selling. I think that's kind of what we're seeing here. So Bitcoin at the moment down about 6.5%. Currently just around 41,000. Now, not too long ago, we're talking about Bitcoin at 47,000, testing resistance at 50,000. I wouldn't be surprised if we still get there, but not today, right? Bitcoin actually trading lower quite a bit. So currently down about 6.5%. We'll call it to 41,000, a little below that. Ether prices around 2,200 again, had pushed well above the 2,000 level, now coming back a little bit. You can see most of the 10 top coins that we track on our platform down quite a bit. So this is one of those where the long-term structure probably still, I don't think this has changed anything, but probably if you have a position and you have a trailing stop, would not be surprised if it gets stopped out on a day like today. Best thing to do is watch this pullback play out, reassess, see where the low goes, right? And that's what we talk about with not just cryptocurrencies, but a lot of things in these big uptrends. You know that the market's going higher. Think of when Ralph Acampora, one of my mentors, was in Resmed here earlier this year, and we talked about how in an uptrend, the market's going higher, so you look for the pullbacks, right? When we pull back, which is going to happen, where do we pull back? Do we keep making higher lows? And making sure that that trend continues is the most important thing. So for now, plenty of room for Bitcoin to come down and still make that higher low, but let's watch that and make sure you pay attention to downside risk. Finishing off here with sectors, as I mentioned, one of the more defensive sectors, arguably consumer staples at the top of the list, finishing out, slightly edging out industrials at the top of the leaderboard, up about 1% for the day. Up 0.9%, slightly lower was industrials, and then technology, number 3, also up about 0.9%. Only one of the S&P sectors down today, communication services, down 0.8%, followed by energy and consumer discretionary, both up slightly from Friday's close. So kind of a mixed bag of offense and defense on both the upside and the downside today. Let's check in on a chart of the S&P 500. Here's the daily chart, and again, we're making new highs, right? And Friday we talked about, or Thursday we talked about the strength going into the end of the week. On Friday we actually had a special episode of the Final Bar called Top 10 Charts to Watch in December. If you missed that, I had a really fun conversation with Grace and Rose. We each highlighted 5 stocks or ETFs that we thought were really important to watch on in the month of December. If you missed that, make sure you go check that out after this live broadcast is done. But one of the things we talked about last week was how the S&P had rallied. The NASDAQ, of course, had rallied as well. Big gap higher earlier in November, pushed to the upside. But really, if you look at the last couple weeks, sort of a sideways choppy market, right? The S&P is sort of range bound between 4,550 and 4,600, not really powering above there. Friday's session really showed the strongest finish to that week, closing above 4,600. So the question when you have that sort of move, do we get a follow-through day on Monday, which means do we see additional pushing in that direction? I would argue we've seen that. The S&P closing again above 4,600, opening below but closing back above. We're continuing to see buyers come in and push risk assets higher. So overall, I would argue this is a fairly constructive market. My market timing model, my market trend model, that is long-term, medium-term, short-term, bullish across the board as of Friday's close, and it's been that way for a number of weeks. So overall, no denying that the trend has been positive. Now let's look at some of the other asset classes, how they've related to this rally that we've seen in stocks. And by the way, before we leave a chart of the S&P, just make a note. This gap that we saw in November that we've highlighted on the chart of the S&P, our chart of the QQQ has a similar gap because that was when the October CPI number came out. It was a gap higher than you saw a bunch of additional buyers coming in, pushing prices back to the upside. The reason why I highlighted that is because if we would, and probably when we get a pullback in stocks, which will happen at some point, that is a really good place to look, right? Those gaps that have happened on the way up can often be magnet prices or pivot points, what we might call, as sort of a potential downside target or an area of support if we pull back. The reason why I want to highlight that is this was the October CPI number. The November CPI number comes out tomorrow. So the last time we had this number, we'd actually had a really good run, but that CPI data came out and really fueled the next leg higher in the rally, and a broader rally of sorts with a lot of names participating in the second half of November. So keep an eye on tomorrow's number. That could be a potentially market-moving announcement for sure. Let's look elsewhere here briefly. I just want to highlight with bond prices. I mentioned no significant changes in the yield curve today. The 10-year long bond points all sort of holding steady from Friday's close. I think it's worth noting on the TLT, we rallied up to the 200-day moving average. And this, by the way, the TLT is a long Treasury bond ETF, so a good proxy for Treasury bond prices or government bond prices. If you look, we were overbought as we tested the 200-day moving average. We've now pulled back from that. From a technical perspective, that actually makes quite a bit of sense. So you'd expect to pull back, and then the question is, what's next? Do we make a higher low? What happens after that? Do we retest the highs? The momentum overall still pretty constructive, and I haven't put a little green box up here, but I need to, highlighting the fact that the momentum is really back into the bullish range that we've seen previously. The question is, do we get above the 200-day and hold it? And if you flip that chart over, that's basically the yield on the 10-year Treasury yield. $TNX is the best way to track that on the StockCharts platform, I would argue. Same thing, we went from 5% on the 10-year down to 4.1%. We bounced off of that on Friday, and I think the real question is, do we hold the 200-day moving average? I don't see the 10-year yield getting much below 4%. I think that's a pretty decent downside target given the strength in yields, given the downtrend that we saw in bond prices, this counter trend rally that we've seen. I wouldn't be surprised if interest rates sort of remain in this range for quite a little bit of time here. But again, look at that 200-day moving average, just above 4%. This is certainly an area of the market where you could expect some changes through the course of this week. Maybe tomorrow with CPI, but certainly Wednesday on the Fed meeting. This and looking at interest rates and bond prices, certainly one area I'll be focused on during that announcement. Bitcoin, as I mentioned, coming off quite a bit. Now, again, it's hard. I don't want to spend too much time explaining what this move means, because I think if you're not ready for these kind of moves, that is your sign from above telling you you probably don't want to be in the cryptocurrency space at all, because I think taking a position in something like Bitcoin means you are opening yourself up to this sort of volatility that has defined cryptocurrencies from their inception. I don't see that changing. This is a volatile space. There will be big upswings. There will be sudden downdrafts. That is the history of Bitcoin is filled with those sorts of moves on the upside and the downside, to be honest with you. Overall, when you've had the move that you've had, as we've mentioned many times here in recent weeks, you're really overdue for a pullback. So a pullback is going to happen. You know that's going to happen. The question is, how tight do you want to have your stop? How much room, how much downside risk can you accept for the opportunity to ride it to potential further upside? So if you're a longer-term investor and you have Bitcoin in a longer-term portfolio, which is how I would describe myself, I'm okay with this sort of move because I'm betting more on the longer-term trajectory, which I would argue is still upwards. If you're a short-term, if you're more of a swing trader, I would say a day like today could certainly have shaken you out of a position, or at the very least tell you that the potential for further downside is very real. Bitcoin actually touched right around 40,000, right around 40K earlier today. I think that's the level to watch. We mentioned that at the end of last week. I would continue to reinforce that as a key level. We hold that on a pullback like we are today, and I think things are still okay, we break 40,000. I think you really want to think about further downside protection, what some downside objectives may be. This is where Fibonacci retracements may come into play. And if we do get that move, we'll spend some time on the chart of Bitcoin, maybe identifying some of those downward moves, downward potential targets as well. Quick reminder, by the way, I'm seeing some questions in the live Q&A. Keep them coming. We'll get to as many as we can here. We're going to wrap the market recap here in a moment, and we'd love to answer your question here live on the air. Here's the chart of gold. GLD is what we're using here. And again, an uptrend is still in play, I would argue. Higher highs and higher lows. So in a pullback like this, it's tempted to say, okay, this is the beginning of the end. And it certainly could be, but I haven't seen enough of a deterioration to tell me that this uptrend is over. The RSI down here in green is still in a bullish phase. And I actually do this manually, just highlighting the areas, because for me, it's kind of part of my process to see when I need to actually add a red box. It really confirms for me, okay, that really was enough of a change that I need to adjust my perspective on the momentum characteristics here. I don't think we're seeing that yet. I think overall the trend in gold, the momentum in gold that is still positive because we're holding above 40 on a pullback. Now, if we break the 200-day, we break the RSI 40 level, I'll start to tell you this may be a much deeper pullback that we want to start thinking about further downside targets. For now, I'm seeing a pullback within an uptrend, but we're getting close to that point where I'll probably make the argument that it's a little bit different. Just to finish off here, looking at some individual areas of the market, and again, I'm happy to aim anywhere you guys want during the Q&A. Semiconductors, I think, part of the story here. The overall market's sort of holding steady, but semiconductors really moving to the upside. The SMH, the SOXX, the SOXX are two of the more widely followed and pretty liquid ETFs following semiconductors. You can see that the SMH is up 2.4% today. That's a nice upside follow through. SMH hit resistance around 160 in July, made a bit of a double top here, pulled back all the way to the 200-day moving average in late October, retraced 100% of that move in only 2 weeks, right? So you've got a 3-month decline, a 2-week rally that completely closes that. Look at this gap here, which ended up being retested as support, and now we're rotating back to the upside. So I certainly see this as a breakout, a retest, and then a follow through to the upside. And a number of individual names look very similar. Here's KLAC, KLA Corp, which is one of the members of the SMH. Broadcom, one of the larger names in the group, about a $480 billion market cap stock, up almost 10% today. Pulling back to the 50-day moving average last week. Friday, a nice bounce off of the 50-day today, just accelerating to the upside off of that level. Even Intel, which in a lot of ways has been an outlier relative to the rest of the semiconductor space, up another 4%. So what's interesting is the only semiconductor name that I would follow, sort of that big group, not participating in the uptrend is Nvidia. And the problem is that's kind of that's the name, right? It's over $1 trillion market cap. It's the largest semiconductor stock. And overall, not bad, right? Not horrible. Pulling back to a 50-day moving average, the RSI is still okay. It's above 40. But it's down almost 2%, while the semiconductor ETF is up 2%. Some of the names like Broadcom up quite a bit further. So you're actually seeing that situation where a leading stock is actually not participating in the rally in the rest of the space. That might be something to watch. Also, names like Amazon really stalling out. I mean, is Amazon a bullish chart here? It's not a bearish chart, but is it really going up right now? No, it's actually down 1% today. And I would argue for the last 3 weeks, stalling out at the September high. So I think we're seeing strength in the major benchmarks. There are a lot of market conditions I could cite for you as being fairly strong. Most bullish, the fact that the market's going up. But there are plenty of names not participating. I think the opportunity to differentiate between what's working and what's not may be getting a little easier here as we continue through the month of December. That's it for our market recap. Again, so many charts we could try to get to on a Monday. Try to get to as many as we could. We're going to go to the live Q&A here in a few moments. Before we do that, a couple quick announcements for you. First off, the live Q&A is a lot of fun, but on an average day, we don't have time to get to the live questions, but the mailbag is always open. You can email us your questions at thefinalbar@stockcharts.com. On X, just tag us in a comment at finalbarsctv. On our YouTube channel, of course, you can always just drop a comment below the video that you're watching on our show or any of our other shows on StockCharts TV. We appreciate your feedback and your questions, and especially your questions as we fill up the mailbag. We'll address some of the mailbag questions. We got some really good ones recently. We're going to try to find a good time to reopen that mailbag. Don't forget to like this video and subscribe to our channel while you're here. It would certainly help us as well. Tomorrow, on Tuesday the 12th, I'll be doing a free webinar with Market Misbehavior called 10 Questions Every Investor Should Ask. You know, at year end, it's a really natural time to look back, reflect on how the year went, think about what went well and what did not go so well. And I'm going to go through a guided tour, going through the 10 questions that I ask myself at the end of every year. I'll share with you what those 10 questions are. I'll answer them, and in the context of doing so, sort of share some of my challenges, some of my successes in 2023, some of the things I'm hoping to improve on in the year to come. I hope this fuels and inspires you to ask yourself those 10 questions. So don't miss it out. It's a great opportunity to renew your process, to think about where you can upgrade your thinking going into the year to come. So to sign up for that free event coming up tomorrow at 1 o'clock Eastern, just go to marketmisbehavior.com/10 questions. All right, let's get to the live Q&A. Again, thanks so much, everyone, for making these Monday shows interactive. We super appreciate the opportunity. Pop your questions in there now. We're going to start at the top, get to as many as that we can. J.R. Boston asks, QQQ, cup and handle on the daily chart. I'm assuming you are actually in Boston. As I may or may not have mentioned it, I spent many wonderful years in the Boston area, almost 9 years. My son was born in there. We lived on the South Shore in Scituate. Say hi to the Atlantic for us for sure. Love Boston. What a great town. All right, looking at the QQQ, a cup and handle. So it depends on what cup and handle you're talking about. I'm guessing you're talking about a larger cup and handle, which is what this would probably look like. So if you look at the QQQ over the last 3 years, which is what we're looking at here, is this a cup and handle pattern? I probably would say yes. Is it an ideal cup and handle pattern? Probably not. And why is it not an ideal cup and handle pattern? So, if you look, this horizontal line, call this the rim of the cup. What you really want in an ideal cup and handle pattern is the left rim over here and the right rim would be identical, right? So ideally the peak would be up here around 400 on the QQQ. It's actually down here around 385, 388 or something like that. So if you look, what's happened is, and again, whether or not you label it as a cup and handle pattern, you've had this big rounded pattern here. We're essentially retesting the highs. Then you have this shallower handle. It really does look like a cup of coffee, and that's why it's called the cup and then handle. And this was a William O'Neill pattern. If you followed Bill O'Neill's work, again, a legendary investor, really popularized a lot of the basic things we assume about the relationship between charts and the fundamentals behind a company. I think William O'Neill really popularized that methodology of what we would call fusion analysis, combining the two in a meaningful way. The cup and handle was a favorite pattern of his. The idea being, after a big run, you have this sort of rounded bottoming pattern, which is the market sort of distributing, and then all of a sudden a period of accumulation, bringing us back to a previous high. Now, the essence of the cup and handle is the handle on the right. That's really, really important, because without that, it's just a double top pattern, right? It's just a level of resistance that we've retested and we don't break through it. A cup and handle pattern means over here on the retest, we actually retest. We have a shallower pullback, a bunch of buyers come in, and then there's the breakout. And what's key with the cup and handle pattern is the end of the handle is a break to new highs. Now, if you think about a lot of price patterns, if not all of them, have a setup, right? And then they have a trigger. They have that moment which confirms that the trend is now reversing or that the signal is confirmed, right? So a head and shoulders pattern, you have the neckline, which is super important. When we see in one of those examples, I usually reiterate that many, many times, that you need to wait for a break of the neckline. This is basically what you're looking at here. I would argue with the move that we're seeing here, I would argue this is a cup and handle pattern. I would say the breakout is good. What's interesting to me is you have this gap. I mentioned on the S&P chart, you have that gap on the QQQ. It's around 380, 385. We pulled back right to that level. So even in the shorter term, you have this little retest of that gap and then the move higher. I see that as a really constructive pattern going into the end of this year, going into the beginning of next year. So again, my default take on markets is to be more cautious, to be more risk averse, because I learned technical analysis in 2000 and 2001 when the tech bubble popped, and that has served me well at market tops. It has helped me, or has really hurt me from not following uptrends when they've broken out. So I really focus a lot of my time trying to ignore that default bearish sense in my head, and I would say the strength that you're seeing in stocks is very real. So whether or not you label it a cup and handle pattern, I would say the action in the last couple of months certainly bullish in terms of returning to that July high and then following through, which I think we're maybe seeing this week. Again, the Fed meeting this week could disrupt that, but I would probably agree, JR, on the cup and handle pattern on the QQQ. And that, if you measure it, suggests much further upside in the years to come. Question number 2, what are your thoughts on Duke from a technical standpoint? DUK. So it's interesting. We haven't brought up a lot of utility stocks very often, and the answer is because I don't get a ton of questions on utilities. I found the people that own utilities and Duke Energy, again, there are different utilities that are in the utility sector, but generally speaking, it's more of an asset allocation decision, right? I don't get a lot of questions on individual REITs either, because they're sort of like do you want to own real estate or not? And if so, it's more of an allocation to the space and less about security selection between there, arguably. So what's interesting about let's start with the bullish thing. So to start off with, I will tell you when you're looking at a utility like DUK or looking at a higher yielding stock like a financial, like a bank, a REIT, a real estate company, higher yielding name in consumer staples or industrials, you really want to take the price adjustment off the table. And the way that you do that on StockCharts is add the little underscore just before the ticker. So when you bring up a stock just with the ticker, we adjust all the data because a utility company, any company that has a dividend payment, what basically happens is you pay out part of the value of that stock as a dividend. So the price actually has these little gaps that happen. What we do is we adjust all the data because we want the indicators based on the price action and not based on a dividend. And so that's why we do it. But if you're really looking at the price action itself, you want to put an underscore before the ticker. And that's a way to basically take the adjustment out. It'll say unadjusted after the ticker. And that's where you're looking. Some of our StockCharts contributors, Miss Schneider comes to mind, Joe Rabel, are really good about consistently putting the adjustment, taking the adjustment out for that reason. They want to look at the pure price action. When you do that, here's what you find on the chart of Duke. It's overbought as it's testing a key resistance level. It's above the 200-day moving average, which is good. It's testing a huge resistance level right around $96, which I would argue not so good yet. This chart is really constructive, in my opinion, if you break above 96, because that would complete that rotation higher, following through on the break above the 200-day moving average. The fact that it's above the 200-day, it's still going up, I would argue is a very bullish sign. The fact that it's overbought at all is good because the last time it was overbought was back here in April. And you look, if it became overbought in end of March, before a much further move to the upside. So I think there could be more upside ahead. I think the argument for a stock like Duke is less about the price action, less about the capital appreciation, and more about the fact that it's a stable name with a decent dividend yield, right? The fact that it's going up means you're not losing anything on the dividend payment, and it's paying out a consistent dividend. So it's actually a pretty compelling bet here, particularly as rates are coming down. The 10-year yield going from 5%. At that point, something like Duke's dividend yield not as attractive. 10-year yield down at 4.1%, 4.25%. Maybe this is a better bet. A stable company in a decent sector, starting to show strength, paying a decent dividend yield. So that was the long-winded answer with a lot of little nuggets in there. But I would say a break above 96 from a technical perspective would help make the case there. Next questions. Any thoughts on coin? I would say coin is a volatile space, so caveat emptor, let the buyer beware on charts like coin and anything related to the cryptocurrency space. Coinbase was actually one of my 10 charts to watch in December, as I mentioned on Friday's show. So again, if you missed that, make sure after this one you go back and review. It was a lot of fun. Grace and I have such a great time talking about charts together, and it was a really good back and forth about some of these charts. Coinbase, I think, is an important name because it's a way to play the uptrend in Bitcoin, which I would argue is still very much there. On the long-term time frame, I think a chart like this is great. And the reason is because it's making higher highs and higher lows, and it's above 2 upward sloping moving averages. The problem about a stock like Bitcoin, or a stock like Coinbase, which is basically a play on the cryptocurrency space, Bitcoin and Ethereum and others, the problem is all that volatility that you get from Bitcoin is magnified or at least certainly reflected in the price of Coinbase. So down almost 6% today. This is a volatile stock. It's the top ranked stock in our Scooter rankings at the moment in the large cap space. It is overbought until today. With today's sell-off, it actually comes out of that overbought region. It had been overbought for the last 4 months. Now, if you look back to the left at other times when we've been overbought for quite a while and then come out, these have been pullbacks. I think what you're seeing here is we've had a really good run in Bitcoin, a really good run in Ethereum. Obviously, they're coming down quite a bit today. This is a pullback phase of some sort for cryptocurrencies. I don't know how long that will last, but I do know this often presents a pullback, a tactical downswing, and usually gives you an opportunity to re-enter after a pullback sort of phase. The last couple pullbacks have gone down to the 200-day moving average. That's a big haircut from current levels. I wouldn't say that that is a necessarily the downtrend objective that I would have, but probably a time to wait and see. If you're a long-term investor, I would be waiting a little bit to see if we get a decent pullback for a better opportunity. So long-term still fine. Short-term, all those overbought conditions we mentioned on charts like Coinbase now kind of coming down a little bit. I think that's a wake-up call for Coinbase. Arguably, there are other stocks like this as well. AT&T down 2% today. Verizon, these are names that have had really good runs, pulling back a little bit. And again, overbought until today. So I think the danger we mentioned earlier in the last couple of weeks are so many stocks overbought. That's a good thing for the long term, but it suggests that we might have a pullback here. We may be getting that pullback here this week. Great question, by the way. You picked RMD Resmed in your top 10 charts. So thank you for watching Acorn. Correct answer. Right? That was one of the ones that I picked. It was my portfolio stock. So I'm getting there to pick up strong charts. Yeah, so I will tell you, I mean, to be honest with you, the stocks that we highlighted in general, fairly strong. And I think one of the consistent things about what we talk about on the show, as hopefully you pick up on, you know, I'm not a swing trader by training. My goal is to look at medium-term and longer-term trends. Having said that, if you're a longer-term, medium-term investor, you still need to understand the short-term environment. And I would say there's a lot of alpha to be made, meaning a lot of improved returns to be had if you're more thoughtful on your entry and exit points. And I think that's one of the great benefits of the technical analysis toolkit. It helps you identify whether today is a good moment to pull the trigger on a bigger theme investment that you might have an idea on. So a lot of the things that we talk about are really more with the lens of trend following, but Resmed was one of those names that had been in such a good downtrend, a consistent downtrend, and then showed a bullish momentum divergence September through November. And that's why we highlighted the stock on Friday's show and really talked about this move to the upside. We've now gone from a downtrend to an uptrend, or what I call a distribution phase, into an accumulation phase. I see this as a strong trend. What's good about trends like this, you can draw trend lines off of the lows and at least minimize your downtrend, minimize your downdraft if there's a pullback in the stock. But overall, I would say a chart like this pretty constructive after rotating to a position of strength. So thanks for noticing that. I would agree. I think a decent chart until proven otherwise. Let's see, CAR up 9% on dividend news. You have until 12:15 load price target 240. Interesting. Let's take a look. CAR. Yeah, Avis Budget Group. I was going to say, I thought that was Avis. You know, if you look at Avis Budget Group, what's interesting about the stock, I mean, is this how would you describe the pattern of this chart over the last year, over the last 3 months, over the last 2 years? I would argue sideways is the best way that I would describe it, right? Think about the market. When I've had Dave Landry on my show, he talks about the three choices, right? It's going up, it's going down, it's going sideways. That's it, right? And any chart you can bucket into one of those three. So how would you really describe the price action on Avis Budget Group? Well, here's the thing. Start with the final bar. Start with the current price and look to the left. We are currently right around $200 a share. We were at the same level a month ago at the beginning of November. We were at the same level a quarter ago at the beginning of September. We were at the same level about a year ago at the beginning of December of 2022. And if you go back 2 years, kind of the same level as well. So the challenge I have with the chart like CAR is that it really hasn't gone anywhere, right? I mean, I'm much more attracted to names that have had broader advances and you're looking for opportunities within there. A chart like, Avis Budget arguably really hasn't gone significant ways up or down. However, if you're more on the swing trading time frame, this chart is a masterclass on using an indicator like RSI and basically waiting for us to be overbought, come out of that overbought region, there's your short opportunity, wait for us to get oversold. We come out of that oversold region, there's your reason to cover a short and go long. We're short here. We were never really, arguably maybe you're long here on the bounce and maybe you got stopped out, maybe not. We're overbought here, but I mean, look at how consistent the support and resistance levels are identifying some of those key points. Most recently, bullish momentum divergence. And a lot of charts had that, right? Lower lows September into October, but momentum that did not confirm the October low. That was one of the things that suggested to us maybe this downtrend was over, and it's really been confirmed by a lot of these rotations to the upside. So I would argue, yeah, coming off of this position of weakness, pretty compelling chart. I would say in the short term, getting above 200, which would get us above the 200-day and get us above this choppy resistance range over the last 6 weeks, I think would arguably, tell you upside target to 240, 250, which would get us back to those previous highs. I don't have a problem with that. But as a medium-term, kind of longer-term investor, I question the long-term proposition here. But as a trade, as we would say, yeah, buying a breakout with upside to the previous highs, I don't have a problem with that. I think that's a justifiable approach. Let's see. Hi, Dave. Enjoy the IFR weather. What would be your favorite Bollinger indicator? So IFR, if you're not a pilot, if you don't know that language, IFR or VFR are basically the flight rules you have to operate on. VFR means clear skies or the clouds are high enough that you can see the ground and see traffic and everything with your eyes. You don't need instruments. IFR means you're only allowed to fly if you're using your instruments, and you have to be rated a certain level, instrument rated, to be able to do so. Seattle has IFR weather kind of November through April, so I think that is the nature of flying around this particular area with our unique weather patterns. But thanks for that. What would be your favorite Bollinger indicator? Boy, that's an interesting question. Shout out to my friends at IBD, Justin and Arusha. I was on Investing with IBD, a month or two ago. Had a really fun conversation with them. They actually just had John Bollinger on their podcast in the last week or two. I just watched part of that interview over the weekend. So shout out to John Bollinger and our friends Justin and Arusha at IBD. They did a great job talking with John about the Bollinger Bands. I don't know if I would say a favorite. I would say the Bollinger Band methodology, really interesting, particularly if I was a swing trader. I would probably use Bollinger Bands and candlesticks way more often than I do. As a medium-term investor, John talks a lot about, looking at breakouts above the upper band or below the lower band as a sign of a move. I would say that's probably the way I would use it now. Interesting on a chart like CAR, by the way. Why don't we? Because we're all here, we're all friends. Pop on the Bollinger Bands and see what happens. So John Bollinger's argument, which I would agree with, is before a big break in either direction, usually have a period of lower volatility. So there's an indicator called the Bollinger Bandwidth or something like that, depending on what platform you use, which basically just talks to you about the spread between the two bands. When the bands are narrowing, that means the volatility's come in, and that's what you saw in August. And then what happens when the bands come in is you wait for the break to the upside or the downside. So the break below the lower band in late August, early September really told you there's a pattern of distribution. The bands have narrowed again here in early December. We're arguably very close to breaking through the upper band. That would sort of add on to additional evidence on the previous question about CAR, right? A break above the upper band after a tightening of the bands is actually quite constructive. So I would say that technique, I don't know if that answers your question, but I would say that idea of narrowing volatility and then waiting for a break, I found to be very, very helpful. And if I traded options, which I really don't, but if I did, I would probably use that a good amount. JR Boston, Denata, happy to help you. And Kenneth Wright, you get our last question today. Hi, Dave. What do you think about Netflix? Let's take a look. I actually didn't mention this one in the market recap. I think the chart of Netflix reminds me of many of the Magnificent Seven charts. Meta, Nvidia are all kind of in this same unfortunate boat where they, overall technically, I would say still constructive. I mean, they're not bad charts, but are they great charts right now? No. In my opinion, great charts are ones that are making higher highs and higher lows. Netflix still has not broken above its July high. Now, Netflix is a little different. A lot of charts do not look at this, but you have this big move higher, made a new high just below, we'll call it 480 here in July, and then a gap lower, and that's actually called a breakaway gap to the downside, an initiation gap, sort of that initial gap lower. Then you saw additional selling went all the way down to the low in October. We have another breakaway gap going higher this time. Then buyers have come in. So we are above two upward sloping moving averages. We're making higher highs, or certainly making higher lows. But for me, we need to get above this resistance. 480 was the high in July, 480 the high in mid-November. This is a great chart above 480. Until then, I would say it's still an okay chart. Would I mind holding this if I owned it now? Probably not. I don't, but if I did, I'd probably hold it. I'd need to see more of a breakdown to get concerned about it, but the momentum is still constructive. Again, we're making a higher low, which I think is good. Getting above 480 is pretty bullish. We get below 430, all of a sudden we're getting down to the 50-day moving average. We start failing there. I think that's a really ugly chart. In the middle, it's a wait and see, right? It's a sit on your hands chart. And I think we're seeing a number of those, to be honest, as we wrap the show, wrap the live Q&A. We're seeing a number of those that are sort of in that wait and see mode. I think the markets themselves, while we're showing strength, a lot of individual stocks are sort of in that wait and see mode. Besides semiconductors breaking to the upside, some other select groups as well. I think there's going to be a lot of, the CPI on Tuesday, as I mentioned, the Fed meeting on Wednesday. That's going to cause these charts to certainly, or arguably, move in a significant way to the upside or the downside. So let's see what happens. Great Q&A, you guys, and thank you so much for all of the thoughtful questions. Any of the ones we didn't get to, we will capture them, put them in our mailbag. We'll do another mailbag episode or two here going forward, and we'd love to answer one of your questions in our show. We got to wrap it up though today and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Can I get back to it? Here we are. Chart number 1. I'm looking at the S&P 500 in the top panel of my first 3 and 3 chart, and I'm looking at the RSP, the equal weighted S&P in the bottom. I would tell you arguably they're both going up, right? And certainly since the October low, you're seeing renewed strength in our major benchmarks. The S&P, the QQQ, really pushing above the July high. That's impressive. The equal-weighted versions are lagging behind there. Now, this could certainly, be eliminated. This divergence, if we continue higher over the next week, really going through year-end. If you see renewed strength, the equal-weighted versions most likely break out. But when I'm looking at the advanced decline data on the New York Stock Exchange, not breaking above 2023 highs yet. When I look at the equal-weighted S&P, not breaking out yet. When I look at small caps, nowhere near to breaking out. So our mega cap driven, growth driven benchmarks are breaking out. But any other evidence I would cite probably is not yet in terms of broad market measures. Anything that takes that mega cap growth overweight off the table is not as attractive. So I would argue the bull case going into 2024 means equal weighted measures need to be breaking out, right? The value line arithmetic breaking out, the small cap index breaking out. Those are signs that there is a broader advance. For now, I would say still a question mark. Now, where I would say you're getting less and less of a question mark is a traditional measure of offense versus defense. This is really inspired by work we did at Fidelity years ago. I talked with Bill Doan, who was one of my predecessors, ran the team in the 1970s, and it was great to be able to talk with someone like that who had actually navigated the 1974 low, that whole period, and what the charts looked like. And one of the things that he and I talked about was looking at offense versus defense. Now, his methodology used a series of indexes which are gone. They've been gone for decades now. So one of the ways I sort of adapted my conversations with him was using the XLY and XLP as a measure of offense over defense. If this line's going up, offense is outperforming defense, and the opposite if it's going down. And then we have the equal-weighted ETFs, which track those sectors as well. Now, the cap-weighted version, slightly breaking out. We'll see. I'd love to see if there's more of a follow-through than we've seen so far. But last week, we did make a new high for the year on this ratio. Now, the XLY is dominated by Amazon, Tesla, Home Depot, and so it's really more about those names and what they're doing. So the equal-weighted version really looks at the average consumer discretionary versus the average consumer staple stock. That is clearly breaking out. And that's the most important line that I look at on this chart. So offense is outpacing defense. It made a new swing low in October, not to be sustained, and now we're actually breaking out to the upside. Out of all the charts I could look at today, probably the most bullish, confirming this strength that we've seen off of the October low and suggesting further upside into the new year. Be wary, and to get to our third chart, I would say remember, if an ETF or if a group is breaking out, that doesn't mean all those stocks are breaking out. And that's a common mistake I find people making, right? When you see the XLY breaking out, you think all consumer discretionaries are, and a lot of times there's a little more of a nuance than you may want to think. Semiconductors in general have often moved together, and certainly the bulk of them continuing to move higher this week and really following through to the upside. The SMH, the SOXX index, and the SOXX SOXX ETF all breaking to a new swing high. The SMH making a new 52-week high today. Not confirmed right now by Nvidia, and I would say the challenge for Nvidia is 500. That was the high in August. That's the high again in November. Are we setting up a little cup and handle pattern and a break above 500 completes that? Maybe, but until we break above 500, this is not a bullish breakout just yet. It's a stock still in a sideways mode. We'll see if we get an upside catalyst through the course of the week, but I would say Nvidia still a bit of a question mark on this current trend. Folks, that's a wrap for this week. Thank you, sir, for this day. Thank you so much for joining us every weekday after the close for the final bar. A special thanks for everyone being a part of our live Q&A. Keep your questions coming, and don't forget to like this video, subscribe to our channel while we're here. We're really close to 100,000 subs for StockCharts TV. We'd love for you to help us get there. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.